All right. We're now streaming live. And just a little note before we kick things off, we do have a new website at mascience.com. So if you get a chance, want to see some other content, podcasts, videos, all kinds of stuff related to M&A, check it out. And there's also a newsletter in there you can sign up for, which we send summaries of some of these podcasts as well and the future podcasts that we're producing. What are you pouring over there?
Coffee.
Coffee. That's what I got my cold
Always.
brew. I'm on a cold brew quick now.
Mine. Yeah, I've never gotten. I don't like the cold so much, but we brew it fresh here every morning. That's also part of Madeline's job as the assistant. She's learned how to do pour over coffees here in the as the McNamara barista.
I'm gonna have to send my daughter over for training. I think that'll.
She'd be happy to train her.
There we go. You ready to go, Deal?
I am.
Let's do it. Hi, I'm Kison Patel, CEO and founder of Deal Room. Today I'm here with Neal McNamara, co-founder of Virtas Partners, an advisory firm specializing in preparing companies financially and operationally for M&A, capital raises, and restructuring. Neal currently leads a team preparing companies for their most critical transitions with an emphasis on exits and acquisitions, including corporate divestitures, which is our topic today. Today, we're going to be discussing how to plan a divestiture from an accounting perspective. Neal, to kick things off, can you describe your role at Virtas Partners and your previous experiment?
Sure. Thanks, Keeson. So I think as another founder yourself, I think you can appreciate that there are quite a few roles that you have in a smaller company. But those that I spend the majority of time with are one, just overall running the business, but also specifically leading our exits and acquisitions and accounting advisory practices. I've spent over 20 years in merger and acquisition consulting, with the majority of the time spent on the corporate divestitures, which is what we're going to talk about today.
Great. So let's talk about corporate divestitures. Where do you start with planning a divestiture?
All right. The start is clearly defining what it is that you're selling. That is absolutely the most critical step. It's setting that, we've called it the deal perimeter, and that the structure of and the definition of what you're selling then drives the structure of the financial data that's going to be critical to getting the deal done and preparing it the way that we're going to talk about how we advise you should when you're doing these divestitures. And the financial complexity that arises from this definition, where the information exists, who can speak to it, all aligned to this definition. That's really what makes this challenging and something that does often take, especially if you're talking about carve outs, quite a bit of time.
Well, can you elaborate about in terms of the difference between a typical private company that goes through a sales process, pretty familiar with, versus when you're working with a corporation that's carving an entity out?
Yeah, so on the corporate divestitures where you're doing a carve out, those are always complex at some level. Some can be ridiculously complex and some can be much less so. Because again, most of the time, what you're selling has rarely been presented in the whole financially, apart from the parent. And so, the times that is not quite the case could be if you're disposing of an entire segment. But even then, if you're disposing of an entire segment, it's rare that you're building complete standalone set of financial statements for that exact business that's being sold. So when you're doing the corporate carve out, by definition, you are preparing and marketing a business that's never been looked at on a standalone basis. And the management team or finance team hasn't ever pulled together that complete set of financial historical information aligned to exactly what's being sold. Because when you're doing this definition, this definition of what's being sold, it could be geographically based, it could be product based. We've even done it. We've done deals where it's been contract based. There are I remember this one deal that we did a decade ago, government contracts. And there were, I think we did 39 versions of the carve out financial statements because they kept, it was all defined by the contracts that were being sold. And they changed 38 times which contracts were included and excluded. So if you think about this model that we had to build that had all the, build out a full set of financial statements for specific contracts being sold. And every time that they added one or took one out, you had to rerun the entire model for the entire 2 or 3 years of history that you were presenting as what was being sold. So you can imagine that the corporate carve-outs can be extremely complex from that perspective. And like I said, there's always some level of complexity. On a complete divestiture of a complete organization, like I said, private company, those can have similar levels of complexity just for somewhat different reasons. And it's really driven by if you've just got poor finance team, poor finance processes, and or technologies. So you could have a privately held company that's been audited, but not at the same level of scrutiny and granularity that you would have in an SEC listed company, for example. You could have a team that you could have a founder-led organization who might have a family member as a CFO. you could have a founder-led organization that's basically just done everything from a financial statement perspective on a cash basis. And all they really care about is the cash flow and what they're, and reconciling the bank accounts, but not necessarily getting everything in the right period and reflecting things accurately from a historical accounting perspective. And so that's where you can get similar levels of complexity when you're preparing financially as a standalone private entity versus the carve out of a corporate.
What's interesting, the way you describe a carve out, it sounds like it's not clear cut and dry. It's almost like there's an infinite way to slice and dice it.
It's never cut and dry. It's everyone is different, and it's funny because you'll have some out there that can market that they've got this, maybe a secret sauce, proprietary technology to execute it. Everyone is tailored. Everyone is different. There isn't some kind of like rinse and repeat process for doing a carve out. You've got to tailor your approach. You've got to tailor the data extraction. You've got to tailor the analysis for everyone.
Right. What's the difference when you're working with a private company versus a public company when approaching a carve out?
So I guess it depends there on the type of exit or carve out that they're doing. It depends on if the public company, because this really doesn't happen with a private, they're not going to do a carve out IPO, or they would rarely do that. But sometimes you can have a public company that's doing a carve out divestiture, but they're divesting through a tax-free spinoff. Those are also normally larger deals. And whenever you involve the SEC in something, this gets tremendously more complicated, more expensive, and more time consuming. So if you think about this, doing a tax-free spinoff is essentially an IPO. So you're taking a piece of a publicly traded company, you're carving it out, and you are going to issue existing shareholders, you're going to exchange shares. So you can say for every share you own in the former parent company, you're going to get whatever shares in this entity that we're spinning off. So you can look at, United Technologies just did this when they merged with Raytheon and they became Raytheon Technologies, but at the same time, they spun off Otis and they spun off Carrier. And now those are complete standalone, separate, publicly traded companies with no relation back to the former parent. When you do that, just like an IPO, you have to provide a standalone set of financial statements, audited under PCAOB standards, full perspective level data that has to be filed with the SEC to complete that transaction. So you really go from something, if you are a corporate that's divesting a business and selling it, or a private company carving out a piece of the business and just selling it, that's a process that can be months. Whereas the spinoffs, that you can get into years, really, on how long that takes to actually prepare and execute and get effective.
Is there public disclosure requirements when you're doing a public spinoff?
Oh, absolutely, absolutely. So you've got to you're going to disclose that you're doing this, and then you're going to have to issue this. It's a Form 10, and that issue this document. You have to file this document with the SEC. You're going to have to update it as periods become stale, up until the point that the transaction, the spin-off, the divestiture / spin-off, is effective, and now you're a publicly traded company. But as part of that effectiveness, you're going to have these these historical financial statements that are filed with the SEC, and then you're just like any other public company, with ongoing financial reporting. The other example that involving public companies that's relevant to this discussion is you could be a smaller publicly traded company, maybe an emerging growth company, filed under the emerging growth rules. Maybe you buy, you're a publicly traded company, but maybe you have break-even income right now, and you buy a privately held company, and it's a small privately held company. The SEC also has rules that if you buy something that's deemed significant, and there's a formal test that you go through, but if you essentially are a publicly traded company that has break-even net income, anything you buy is significant because of just the way the percentages work. And so I actually, I've got a friend who's a CFO of a publicly traded company in this situation now. They're looking at buying a $50 million top line revenue business. And they're going to have to, if they close that acquisition, they're going to have to file 3 years of financial statements, audit under PCAOB rules, SEC compliant, for a business that's I don't even know if they've had maybe an audit in the past, but certainly hasn't been that. So literally, and that would be a condition to actually close that transaction. So if you think about it from the seller's perspective in this discussion, what that business should have done, should have realized that if this public traded or other publicly traded entities would be in the buyer universe, and really their investment banker should have advised them on this. Not saying they did or didn't, this is just what should happen. That they should have been prepared for that possibility and planned for it, because that's going to add months upon months to the timeline of actually being able to complete that transaction.
Wow. So there's things get complicated when you're public. You got to deal with like audited financials, disclosures, longer time frame. When you mentioned PCAB, they say it right?
PCAOB.
Say it one more time.
PCAOB.
What? Tell me about it.
Oh, well, that's the oversight board that that issues the auditing rules and requirements for publicly traded companies. That's all. So that's where the requirement, when you're having to get an audit under those standards, any publicly traded company, what the auditors have to do is a whole nother level. Versus if you're a private company, what the auditors have to do is not nearly, well, the reality is they don't have nearly as much risk. So they don't do as much work. And I think that probably is a good segue into the another I guess takeaway lesson learned from this process. If you are a privately held company getting ready to do a divestiture, whether it's a carve-out divestiture or a wholesale divestiture, one of the things we have conversations about all the time is how often a set of audited financial statements is still wrong. And well, and wrong can be loosely defined, but in the deal terminology, the purpose of an audit, especially, well, the purpose of any audit, is not just for valuing that company in an M&A transaction, and especially when you get down to a privately held company, the audit is done under a different purpose than making sure that whoever's buying this understands how to value this company. and the procedures that are done at a different level and for a different reason. Therefore, when we get involved in private company transactions, it's more likely than not that we're going to find adjustments to the historical financial statements, true like accounting adjustments, not just deal adjustments or pro formas, management adjustments, but things that really they got wrong and that the auditors just simply didn't catch. You could, rightly or wrongly, sometimes it's, fair that they didn't catch it. Sometimes they should have. But the reality is we almost always find something they missed. And so one of the tactical takeaways, I know we talked about wanting to work those throughout this discussion. One of the tactical takeaways that I have and something that I normally bring up, because this almost always comes up, especially if you're dealing with privately held businesses. Well, we've got audits. Can't we just rely on those? And the answer is unequivocally no, you can't. It's not good enough, done for a different purpose. And we almost always find things that auditors missed. So that's a real important piece of this. And if you also take that to the carve out scenario for a corporate divestiture, I can't really remember too many carve outs that I've done over the last 2 decades that we haven't had to, again, adjust historical accounting within that entity. And I'm not talking about presenting it in a different way because it hasn't ever been presented that way. This is an accounting error that we're actually having to restate historical financial information that really results back, which ties back to the parent. So technically the parent should restate for this if it's material. The trick is most of the adjustments that you find, especially if it's a large parent divesting a small entity, wouldn't be material at the consolidated level. Therefore, it's not a big issue from the parent company's perspective when you catch this. So it's not this big issue that you have, generally speaking. It's almost fair. It's like, okay, well, this is so small compared to the consolidated parent. It's not a big deal. Where this can become a big deal, though, is in the spinoff scenario, because I've been involved in quite a few transactions because you have the same auditor issuing their opinion on the parent company financial statement, generally parent company financial statements, and then the spun off entity. And I've been in the room many a time where that audit partner, has a mandate that there will be no historical adjustments made to these financial statements that would indicate that there was something missed in the parent company, even though it was. So that again can add all sorts of fun jumping through hoops and trying to justify certain positions and whatnot so that things aren't restated within those financials. But I can't think of a carve out where we haven't found something that should be reflected differently just from the historical financial statement perspective.
So audits aren't always cut and dry either.
Or they're done for a different purpose.
Yeah.
Audits are, their purpose is what their purpose is for, and it's not for the getting comfortable with how to present and value a divested business.
Where do QofEs fall into all of this?
QofEs. All right, so this is a bit of a soapbox at times for me. So QofEs. So the quality of earnings, which again, very loosely can be very broadly defined. QofEs in theory, I would say, are generally recognized to be done for 3 reasons. One, you reduce surprises that you will encounter when the buyers come in and perform their due diligence. All right. 2, the package that's presented as part of the QofE is going to result in the seller having more credibility with the buyers when they're analyzing the business. Again, that's whether it's a carve out or a whole sale divestiture of a privately held company. And 3, reduce the timeline of the buy side due diligence. So that theory is that if you do all the same work that the buy side team would do, now they don't have to do that. So in my experience, number one, in my opinion, I guess, the first there on reducing surprises should always that's credible. That should, if you have any capable service provider performing a sell side QOV, you certainly should. You're doing the same procedures that the buy side would be doing. You should eliminate and find some gotchas that they would have found. So that should always happen. 2 and 3, that certainly does not always happen. And that, whether 2 and 3 happen and going, whether you have more credibility, whether you reduce the timeline of buy side due diligence, that really is determined by the scope and quality of the procedures done in that QOV. So I have plenty of private equity clients that will get a sell side QOV, take a look at it and throw it in the trash and do everything they were going to do the same. So it does not always happen. But if you perform targeted, detailed procedures, with a thought to what the buyer really is interested in, what the buyer needs, that can be difficult because you can have a broad universe of buyers, so that makes it more challenging. Again, what a corporate entity that's looking to integrate this versus a private equity firm that's looking at this as a platform acquisition, those can be dramatically different ways of assessing and analyzing the company. So that can make it challenging, but you can do this in a way, perform procedures that will result in gaining more credibility and reducing the timeline.
I guess would it also be a tool just in terms of, I guess, preparation? So you're just generally not blindsided by any of the sort of diligence coming on from the buyer in general.
Yes, it'll do. Yeah. It will open the management teams, owners, or whoever's involved in the sale. It will open their eyes to what to expect, which can be very important, especially if you're dealing with a management team or an ownership team that hasn't done this before. Then it's a real shock to the system. So it's helpful to take them through those paces before it's being done by a party that's really working for somebody else. And the other thing that it does that's extremely important is it can reset expectations on what you're on price. When we get in, again, many times we will start pulling together what we believe an adjusted EBITDA looks like with a truly independent view. So not pulling together marketing, but looking at it as if we were on the other side, beating the crap out of this stuff. What would we be doing, and what position would we take? And very quickly, and this has happened a number of times, where it's like we do that, and the buyer's like, or I'm sorry, the seller. Especially in privately held businesses, and the seller's like, well, wait, that EBITDA times this multiple that my investment banks tell me about doesn't get me there. That's not good enough. What do we do? And a lot of times that, too many times that results in them trying to get creative and work other adjustments into forecasts and whatnot. Other times, and we haven't seen this on the sell side as much, but you do have a lot of, and this is why some of our clients will just throw QOV reports in the trash. Some of them will view those QOV reports just as marketing documents that are all about the upward adjustments to EBITDA versus a more independent and objective view of what the historical adjusted EBITDA should be. So that, and sometimes it results in just deferring the deal. And it's like, all right, well, what you need to do is make some operational improvements to get that trailing 12-month EBITDA up to the level that gets you the exit that you're looking for.
Right.
Here. You're not going to get there with playing with the accounting. But especially in in private companies, if you're talking about the wholesale divestitures, there are almost always things that can be done to make operational improvements, or you start exploring operational improvements that a new buyer could make that would result in higher levels that maybe you get some credit for as well. So those are some of the benefits of that Q of E process. But I think that, again, going back to will it really add credibility and reduce the timeline? I think to do that, you need a scope of procedures that are very detailed, that are not just off the shelf carbon copy, just generate a standard report, but it's something that if I'm coming on the other side, can really it just walks me through. So I don't have to dig this stuff out. I can look at and just, almost like an audit trail, use not for an audit, but just a bridge of, all right, I can see how this data ties back to how you're pulling from the system. I can see the validations that have been done on an account by account basis. I can see where adjustments are made, and I see all their support for these adjustments, and I can go back and understand exactly what was done, and it holds together. That can really reduce that timeline, help the credibility, et cetera. But that's a lot of work as well. And so that's where you can get to. That's where you get the conflict of, sometimes the sellers just want, they don't want to spend the money on it. They just want to report. They want again, and then it becomes more of a product, and it's really, and then you're not going to get the value. So spend 50% more, 100% more at times to build a really great data set to accomplish those things, instead of being a bit penny wise in this process.
Interesting. That's interesting. It seems like a decade plus ago, it really wasn't a part of the process.
It was. Yes, you're absolutely right. I think you had there were early adopters. In Europe, this has been happening forever.
Yeah.
Vendor due diligence. I mean, I spent, this is almost 20 years ago now, when I worked for a few years in Zurich. And even then, vendor due diligence was a absolute standard approach for selling any business. And we worked on them back then. When I repatriated back to the United States, it was so uncommon to do any form of vendor due diligence, sell side due diligence. Quality of earnings there wasn't anything called a quality of earnings report necessarily back then. I think it was more just a due diligence report. There was a quality of earnings slide within there. It's been kind of like all rebranded now, but the work that we did. I think when I think about 20 years ago back, and even maybe I guess 10 started adjusting, but it was the sell side preparation from an accounting perspective was much more focused on the big large transactions that had to have standalone carve out audited financial statements prepared, and that's what we worked on over and over and again, and that was a big piece. Whereas now it is rare if you find an investment bank that will take an entity to market without having one of these done. And again, what's the reason for that? Well, the reason for that is that they've been burned so many times by going to market with a set of numbers that get just blown up when the buy side diligence team come in. And that's. We were talking the other day about where does this go wrong? That's the cardinal sin, I think, in a sell side process is taking something to market with numbers that haven't been vetted by somebody like me. I can't tell you how many times I've seen that happen. I've had to come in and fix it.
You're going to get quoted on that, by the way, in the highlight reel. The cardinal sin is just not having financials audited by me. I love it.
I mean, we've got, we did a deal a year ago where, and I use this story quite often when somebody's asking why should we hire somebody like you? It's not even just you, right? Why should we hire somebody like you to do this work? And that can be a discussion. I could be having that discussion with a sell-side investment banker or a corporate entity or a founder. And, one of the examples I use is that we got brought into a deal a year or so ago, and it was a carve out. It was a publicly traded company, carve out a non-core asset. They had the investment banker called us, brought us in. And the story they told us was, all right, well, we took this to market 18 months ago, and we didn't do any of this financial prep. And we took it to market. We got into due diligence, and it was such a disaster that the offers were basically like fire sale offers. They're like, the buyers kind of came in, most just walked away and said, this is, we can't get comfortable with this. And then a couple that, didn't really care. They're like, all right, this is so messy. I'll lowball the offer here. And if if you want me to take it for a song, then I'll do it. Yep. So 18 months later, so then the seller just said, yeah, no. And then the banker, that's painful for the investment bank, right? They work completely on success fees. So they may got a small retainer. So they go to market, they spent all this time and got, and basically have a loss engagement on their hands. So process spins back up 18 months later. And they told their client, they're like, listen, we will not start this process formally. We will not talk to anybody else. We're not going to send a teaser out. We're not going to contact any potential buyers until you do a full scrubbing and preparation of a standalone set of financial statements for this business. And you're hiring these guys, which I loved, obviously. And so they walked us in, and we go and we do the full set, prepare, pull together. And this is, again, where we talk about, was it a sell side QE? I wouldn't say what we did was a sell side Q of E, technically speaking. Was there a sell side Q of E within the procedures? Yes. But what we did was we prepared a solid set of standalone financial statements that could be used as a baseline for due diligence to come in on the other side. And as we were doing that, you also then worked through all the standard management adjustments, pro forma adjustments, and everything that's required, and the working capital analysis that's typically included within a scope of a sell-side Q of E. But it was much more than that. And the result there was it did actually, going back to my 3 points, it did remove surprises. Obviously, it allowed the deal to go forward, which is kind of nice. It certainly we had more credibility with the buyers, and it resulted in a more efficient due diligence process. And the best part about it is that the ending price that was paid was somewhere around 5-ish X what was offered 18 months earlier on a business that didn't change. So there were no market or business specific dynamics that resulted in this business being more valuable than it was taken to market 18 months earlier. It was simply sold for that much more because they did a good job preparing it. Wow. And somebody could get their arms around what it was they were buying, and have confidence that in how to analyze this.
Yeah, real interesting. Clean financials mean better buyer confidence.
Absolutely, and the investment banker's perspective is that it's why they mandate these now. Because they don't want those surprises. They don't want that example of spending all this time taking it to market and having it just blow up. They want they want a better chance of success. And so that is, like I said, it's now the exception is that they will allow a client not to hire an advisor to come in and do some form of sell side Q of E, sell side due diligence.
Yeah. Can you walk me through what planning a divestiture looks like from an accounting perspective?
Sure. So if we go back to, I think, the first question you asked me, again, it starts with clearly defining what's being sold. And then once you've got that, what's being sold, then you've got to, and I think about this pictorially, we always prepare in the work that we do, we always prepare a pictorial representation of what's being sold here, from an entity and business perspective, and then where's all the financial data coming from? And that is where the real heavy lift and the can be, because, or at least what makes that complicated? What makes that complicated could be whether you are pulling this from different systems, the quality of those systems, the consistency or lack thereof of the data, and the people that can actually speak to the data that's coming out of those systems.
Right.
So if you think about, a carve out example, you could have a direct feed from the parent company ERP at some level to this. Maybe it's a business unit, maybe it's a legal entity, but maybe it's 100 legal entities. And so you can get a feed there that takes you down to some level of accounting. Sometimes that's only margin, and a lot of times it's only margin. So you can get a direct margin for this business, but then everything else is in other places. So you could have a corporate entity that holds all the SG&A from an accounting system for this business being sold. So now you got to somehow figure out a way to pull SG&A costs out of that system. Then you can also, from a balance sheet perspective, you can have assets and liabilities held in different entities, across the board. So you got to go figure out and find out where that's coming from. You could have, we have this one carve out that we were working on. It's essentially splitting two businesses in half. But again, we had in the business being sold, you had one entity that you had almost a full set of financial statements, but then you had a Chinese entity that was all the accounting was done overseas, and we had to pull that in. Then you had another entity they just bought, but they didn't have access to all the financial statements. So you only had condensed financial information that somehow you had to feed all of that into one set. And so you can imagine, as I'm using my hands here, you imagine the flow chart these flow charts that we create that show this system, this entity, that entity, all these things feed together to get to the end product of one column of adjusted EBITDA. And so again, a lot of our, the volume of the work that we're putting into this, work that should go into this, is building out, you think about all those different entities, systems, et cetera. Think of just a typical Excel sheet format where, that's just a different column. Here's the extract from here, here's the extract from here, here's the extract from here. Here's how it all comes together and ties into this one column of 2019 adjusted EBITDA or LTM adjusted EBITDA. So that's a huge part of preparing financially, for this divestiture. The other piece that's also very important is thinking through what other elements that aren't just an adjusted EBITDA are going to be important for the buyers in evaluating these transactions. A typical one would be gross margin by customer, SKU, et cetera. And how does that data exist? Or if it does exist, what's the fidelity of it? So we've got brought in just to certain deals where the banker, it's not even ready for a Q of E, but they're just like, we need to figure out SKU margins. And the CFO can't figure out how to pull that together for us. And can you guys parachute in there and dig into the systems and see if you can extract that information that we can use so that we can start assessing the evaluation impact for these, margin level SKUs and the story that we're going to go to market with on this. And so first you got to identify, okay, does that data exist? How do you extract it? Once you extract it, can you tie it back to anything? So it doesn't really help if you pull together this great pivot of gross margin by SKU, but then your gross margin that, when you sum up the gross margin by SKU, it's off by millions of dollars from total gross margin. You've got, how do you reconcile that back to the financial statement? So again, this is part of, my mantra on don't release any of this until you get comfortable with everything. Don't put a teaser out there with some adjusted EBITDA that then we're going to have to go back and try to figure out how to bridge to. Same way, the thing is like, don't go and show customer level SKUs until you make sure you got it all and that you got it right. And that's a real heavy lift on the financial prep. And once you get to that, I would call like that baseline of comfort with the historical financial data. After you get there, that's when you can start focusing again, in my opinion. That's when you can start focusing on the adjustments that you can start making to that are more deal specific. So, and this is where you get to quality of earnings adjustments. So now that you are comfortable it's right from an accounting perspective, that you've got stuff in the right periods, that you haven't, you've got appropriate revenue recognition, et cetera. Now you now you can take a look at that and say, all right, let's try to keep that part off the table. So when diligence comes in, let's have them sail through that we have appropriate historical accounting. Let's let them focus on really digging into the deal specific items that impact the valuation to this. And that's where, the Q of E comes in. What are the historical adjustments that are for valuation purposes versus accounting purposes? So typical examples are, we incurred we had a big non-recurring write-off. And so if you're in the last 12 months, did a restructuring, we had a big, I guess you could say something about COVID, but I won't get into that because that's a whole other issue. But a non-recurring expense that if you are going to be pricing us off, if you're going to put a multiple on a trailing 12 EBITDA, we shouldn't be dinged for this expense. So back that out of the historical adjustments and give us credit there and increase the EBITDA so that we get credit for that. Here are adjustments that or expenses that will go away if we're owned by somebody else. Very, very typical ones, founder-led organizations. You don't have millions of expenses that the founder incurs that won't continue when it's owned by somebody else. So that is a very typical adjustment that's made there these are management adjustments within a quality of earnings. Then you've got the pro forma type adjustments on, all right, well, what is a standalone cost for this entity? This is especially relevant in a carve out where you might have an allocation from the corporate entity to this entity that just flows through these financials that we've prepared that are appropriate from an accounting perspective, but don't necessarily reflect the costs. And it could be either way. It could be way underburdened. It could be way overburdened. It doesn't necessarily reflect what going forward costs would be once owned by somebody else. And that's always an interesting one as well, because that answer of what standalone costs would be completely depends on the buyer. That view from a large corporate coming in that's going to digest this entity versus a private equity that's buying this as a platform, it's a completely different number there. And so some, one of my, again, I think we talked about tactical takeaways. One of the pieces of advice that I give when we're doing this work is don't spend a ton of time in that area until you really have a good understanding about your buyer, the buyer universe, and get some broad-based, get yourself educated on what they may come back with, on what they believe the historical costs are. But at the end of the day, they're going to layer in what they believe the costs are, and they're going to ding the valuation, or they're going to adjust the EBITDA themselves for whatever it is. And maybe you'll be able to argue that, but wait until then. Don't spend a lot of money on me going in and preparing what standalone costs could look like and evaluating corporate allocations until you have a better idea of what the what the buyers really are going to think, and spend your time on other areas that are more objective and will help the diligence process more.
So we talked about first step, focus on the quality of data and really make sure that's presence, and then moving that into the sell side Q of E, so you can really define what the adjustments are going to be for your valuation models and et cetera. And then it's understanding the value that comes in with working with your potential buyers, and then getting an understanding of who those buyers are. What are some of the unique scenarios in divestitures from the accounting perspective? Specifically with divestitures.
Yeah, one of the things that's, I think, unique to this and consistent across most of these, whether it's a carve out, whether it's a private company sale, is the sellers almost always lack the appreciation for how hard this will likely be. So they really lack an appreciation for how messy it can be from pulling the data. They lack an appreciation for the effort that it takes to get that cleaned up. And they lack the appreciation, we talked about this earlier, for how beat up they're going to be when the other side comes in and is digging into this. And so I think that's pretty consistent there. And I think the other unique and surprising yet common occurrence is something I referred to before, is it is so common to find errors in the historical accounting. As when you have somebody dig into it this way and evaluate the accounting and the history this way and evaluate your data this way, it's not uncommon at all. It's actually probably more common, I would say.
What are some of the other typical challenges you come across?
Let's see, are there any that I haven't mentioned so far? The first is the one that I was speaking to earlier, is the biggest challenge is when financials have been released, the cardinal sin I referenced earlier, right? We release financial data before we've had a chance to really dig in and vet it. That makes everything harder. It's very frustrating to get the call and be brought in to do the sell side Q of E or other divestiture preparation. And the teaser's already gone out and the sim's almost done and we got all this, and it's just like, and we have to work backwards, or have to not necessarily work backwards, but backtrack. It's the more difficult part. And it's actually more difficult for the investment bank. They're the ones that released it. It's not our problem per se, but we have to do quite a bit of work to help bridge. All right, here's what the history actually was and why it's different than what was released earlier. And that's just bad. And so the best practice there is you got to get this done, get this done before you go to market. That's the biggest challenge, I would say.
Is there like a time frame you want to, and obviously it varies in the complexity of the company, but because this is the theme I'm reoccurring throughout this conversation, that you got to prep early, you got to get your ducks in a row.
Here's the time frame. As soon as the investment, well, if you're if I'm speaking to an investment banker, the time frame is as soon as you've signed up your mandate, you call us. And this actually happened yesterday, so it was good. We've got a good investment banking partner that did this. They literally got a mandate, and they knew before they did an ounce of work that they needed to get this process in motion. Similarly, if you are a seller, or corporate, corporate or private, again, getting this process even while you're selecting. I mean, ideally, in my ideal world, is that I'm having this conversation with the seller before they've even selected the investment bank. And we start helping pull this data together that actually allows them to make their selection of the investment banker easier. And then again, makes and helps their mandate as well. And we can even participate in that process. That rarely happens. That rarely happens. So at least if you got to get it going before you get that teaser out is the very least. The other two, I think, that come to my top of my head challenges, when we're not given full access to data. That's a real challenge here. What we like to have when we're helping is you just literally give us a seat on the ERP, give us direct access to everything, so we're not limited by whoever in management is in the know for what's happening and their capacity and capability to give us the data that we need. Just get it to it. Let us directly pull it out. Everybody wins in that scenario. The management team is not burdened with as much work in the transaction. We aren't delayed in our work. We don't have inefficiencies by somebody not being able to pull the data the right way, et cetera. And the other part is also when this difference between, look at the historicals and look at the forecasts. Other areas that we've been, that deals have been burned, have been when the management team does all this work on the forecast with the investment bank, and they keep us in our box of, you guys just do this work on the sell side QB, you guys just do the, you stay in your history accounting, we'll take care of the forecasts. And then they go to market, and there's some blatantly different assumption that's used from a cost structure in the forecast than in the quality of earnings. It's just like, and it would have taken us an hour, or probably if we were just been sitting as part of conversations, to have pointed out, if we just would have been involved, to have caught that before it goes out. And we talk about the credibility factor. Credibility's completely blown up. And again, it takes a good due diligence team on the other side about 2 hours to figure that out when they're looking at the forecast and comparing to the history there. So those are typical and large challenges that we incur during this process.
I appreciate you sharing those. Those are great examples. What's your advice to the buy side in order to get the deal done?
Ooh, okay. Buy side, because we do this as often on the buy side as we do the sale. And the advice really depends on the type of buyer and what they are being sold. So the first and obvious from this discussion is, again, you've got to really dig into the financials. If there was a sell side QB, you really have to dig in and understand how good of a job, how detailed of a job that preparer did and what they didn't do, especially when it's a carve out. So that's there again, unique challenges, unique ways of looking at that and evaluating those. So that's really, again, I mean, the reality is what we do on the sell side or on the buy side is exactly what we do on the sell side. Is we go through and we map out where all that data is coming from. We reconcile it back to historical books and records that feed into some level of an audited financial statement, and make sure it all holds together before we start even getting into understanding and analyzing the management and pro forma adjustments in the Q of E table. So that's the first and obvious one, especially with regards to this conversation. I think the one that we haven't touched on at all is we have private equity clients that specialize in buying corporate carve outs that aren't prepared in this way, that actually didn't go through the process of preparing in the way that we talked about. And they love that because they believe they can extract quite a bit of value because it wasn't well prepared. And they've got pros like us on the other side that can go in and do quite a bit of this. And again, identify where there are adjustments that the seller should have been aware of if they would have hired us or somebody like us on the other side, et cetera. And so they really know how to do this. And so but where they need to focus more time and effort on, less about actually getting the deal done, it's preparing for successfully transitioning the deal to their ownership. And that's about thinking on how what does this look like day one for us operationally? If it's a platform acquisition, how am I going to extract this entity from the parent company and start operating as a standalone basis? And what's going to be challenging within that? And that's where my advice there is you need to do more of that preparation work within the due diligence process, and then be ready to hit the ground running and execute that transition, especially in that finance function, et cetera. Execute that transition day one. In a similar vein, you've had others on your podcast that have spoken about this from an integration perspective. If you're a corporate acquirer, or if you're any add-on acquisition, you need to spend more time during the due diligence phase on really understanding what the integration challenges are going to be and how you're going to integrate this company, and again, hit the ground running once you've actually closed the acquisition.
Yeah, it's interesting. Does some of that map over well when you start looking financially at a company in terms of interpreting that into part of your integration plan, but even on a broader sense of looking at things functionally and how you'd integrate the company?
Yes, absolutely. Because in theory, you should be evaluating what those standalone costs or what your synergies are in the due diligence process, and therefore you should have an understanding of what how you're going to actually do this and integrate it. Similar and likewise, outside, if it's a platform, when you layer in what your standalone, use an example, finance function, right? I guarantee you that the carve out financial statements will never have the cost of a finance org in there that are going to be close to what you're likely going to have, on a standalone basis. It's a completely different structure and cost structure when you're doing that. And so you need to, when again you're evaluating your quality of earnings adjustments and what you're going to really give, what you're going to look at and accept from a historical adjusted EBITDA, you should, that cost needs to be in there. And therefore you then should start thinking about, well, how am I going to actually execute to that cost once I own this company? What are going to be my one-time items that are going to come across that I just have to take on when we're in there actually standing up a new finance org, and when I hire a CFO, and when I implement a new ERP? Because I don't get an ERP when I buy a carve out. I get a transition service agreement for some period of time, and I need to stand up a new ERP. You need to understand what all those costs are during diligence, and have a plan to execute to those, or all of a sudden the first year you're gonna be way off your targets.
What's the craziest thing you've seen in M&A?
Oh, I knew you were going to ask this question. I don't know if I haven't seen too many crazy things. I've seen some really dumb things. I probably had to do some really dumb things. When I think of maybe one of the, I'll go back to my first corporate carve out experience. I guess one could call this crazy. I was working in it was when I was in Zurich, and I was doing a deal in Germany. It was a huge corporate divestiture spinoff. I think it was a foreign listed company from Germany that was listed on the U.S. stock exchanges that was spinning off a big piece of its business. And we had an army out there preparing the financial statements that were going to go into the filing, and they didn't have, again, confidential transaction, space issues. It was a chemical manufacturer, and they set up for many months. They set up these wonderful offices for us, which were we call them the containers, which are metal boxes without air conditioning at a chemical plant in Frankfurt in the middle of the summer. and profession back in the days where professional dress was also required, you got everybody in suits working 12 to 15-hour days, sweating profusely, trying to get this, doing a carve out with half the team that's never done one before. It was not that fun, and I guess crazy is a word to describe. The other I think crazy part of that transaction was part of the culture, at least of that team, was if somebody was older than you in age, there was this extra level of respect and lack of your need to review their work product. Oh, again, this is kind of how things have changed. You did this huge corporate carve out all in Excel, and Excel, 20 years ago operated a little differently, and the processing power of our computers were different back then too. And we had this huge Excel model doing this corporate carve out. So you think about that map of all the data flows that we had all going into one person's computer, not backed up on anything, not reviewed by anybody, because the guy was in his 50s, but he was he never passed his German CPA exam, so he never got promoted to manager. So he just always stayed as this kind of associate level. But he was older than everybody on the team, and so none of the senior managers or partners would review his work because it would be viewed as disrespectful.
Wow.
And so as one could expect, at the 11th hour, there was a huge blow up, a formula error in the Excel file because nobody reviewed it. I remember sitting in the metal container at midnight with 20 people trying to figure out what to do because the Excel didn't work anymore. So that was another relatively crazy. I don't know. That's too crazy.
In the hot box.
Yes, in the metal box.
Did they at least give you fans and some bucket of ice?
It's funny. We had like these little individual fans, but it's in August, just blowing hot air. It's not doing anything for you.
It's circulating hot air around. Yeah.
Not doing anything for you. Oof. Yeah.
Awesome, Neal. I enjoyed this conversation. I learned a lot about accounting procedures on the sell side.
Thank you. Always fun talking to you, and appreciate this time.
Yeah, look forward to the next one.
All right. Thanks. Talk soon.